Overview of the Basel Committee Customer Due Diligence Principles. The Basel Committee on Banking Supervision developed Customer Due Diligence (CDD) principles to strengthen the integrity and stability of the global banking system. These principles emerged from concerns that criminals were exploiting financial institutions to launder illicit proceeds and conceal illegal activities. The Basel Committee emphasizes that effective customer identification and due diligence are fundamental safeguards against money laundering, terrorist financing, fraud, corruption, and other financial crimes. The principle supports sound risk management practices and complement international standards established by the Financial Action Task Force, FATF. Proper implementation protects banks from reputational, operational, legal, and concentration risks while promoting public confidence in financial institutions. Core elements of Basel Customer Due Diligence. The Basel Committee's CDD framework is built upon several core elements designed to ensure transparency and accountability. These include customer acceptance policies, customer identification procedures, ongoing monitoring of accounts and transactions, risk management systems, and enhanced due diligence for higher-risk relationships. Financial institutions must understand who their customers are, verify identities using reliable documentation, and determine beneficial ownership where applicable. Banks should also understand the nature and purpose of customer relationships to establish expected account behavior. Continuous monitoring enables institutions to identify unusual activities that may indicate money laundering or terrorist financing. Together, these controls form the foundation of an effective AML/CFT compliance framework. Risk-based approach and beneficial ownership. A critical aspect of the Basel Committee's guidance is the application of a risk-based approach to customer due diligence. Banks are expected to assess customer, product, geographic, and transactional risks and apply controls proportional to those risks. Enhanced due diligence should be performed for politically exposed persons, PEPs, high-net-worth individuals, complex ownership structures, offshore entities, and customers operating in high-risk jurisdictions. The committee places particular emphasis on identifying beneficial owners and understanding who ultimately owns or controls accounts and legal entities. Without transparency regarding ownership, banks become vulnerable to misuse by criminals seeking to conceal illicit proceeds through shell companies, trusts, and nominee arrangements. Basel Risk Management Model. The Basel Committee promotes a comprehensive risk management model that integrates customer due diligence into enterprise-wide governance and compliance programs. Banks should establish robust policies and procedures, ensure oversight by senior management and boards of directors, and maintain effective internal controls. Employee training, independent testing, record-keeping, and reporting mechanisms are essential components of this model. Supervisors are expected to verify that banks maintain adequate Know Your Customer (KYC) standards and implement procedures that prevent intentional or unintentional facilitation of criminal activity. By embedding CDD within broader risk management frameworks, financial institutions strengthen resilience against financial crime while supporting regulatory compliance and operational effectiveness. Overview of the Wolfsberg Group AML Principles. The Wolfsberg Group is an association of major international banks that develops guidance and best practices for managing financial crime risks. Its AML principles for private banking are particularly influential because private banking services often involve wealthy clients, complex structures, international transactions, and heightened confidentiality expectations. The Wolfsberg principles supplement regulatory requirements by providing practical guidance on customer acceptance, due diligence, monitoring, and risk management. The objective is to prevent private banking services from being used to launder money, finance terrorism, or facilitate corruption. These principles have become globally recognized benchmarks for effective AML controls within private banking environments. Customer acceptance and enhanced due diligence in private banking. A central component of the Wolfsberg AML principles is the customer acceptance process. Private banks must conduct rigorous due diligence before establishing relationships and should avoid accepting clients whose backgrounds, activities, or sources of wealth cannot be adequately verified. Enhanced due diligence is required for high-risk clients, including politically exposed persons, individuals from high-risk jurisdictions, customers with complex ownership structures, and those involved in industries vulnerable to corruption. Banks must identify beneficial owners, understand sources of wealth and funds, and evaluate reputational risks. These procedures help ensure that private banking services are not used to conceal illicit assets or facilitate criminal activities. Source of wealth and source of funds framework. One of the most important Wolfsberg concepts is the distinction between source of wealth and source of funds. Source of wealth refers to how a client accumulated total net worth over time, while source of funds relates to the origin of specific assets entering a banking relationship. Private banks are expected to understand and document both elements, particularly for high-risk customers. Unexplained wealth, inconsistent financial information, or complex transactions lacking economic rationale may indicate money laundering risks. By verifying wealth origins and transaction funding sources, banks gain greater transparency regarding customer activities and reduce vulnerability to financial crime exposure. Ongoing monitoring and private banking risk management. The Wolfsberg principles emphasize that customer due diligence is not a one-time event but an ongoing process throughout the customer relationship lifecycle. Private banks should continuously monitor account activity to ensure transactions remain consistent with a customer's known profile, source of wealth, and stated objectives. Periodic reviews, transaction monitoring systems, sanction screening, and escalation procedures support effective oversight. Suspicious activities must be investigated and reported when appropriate.